studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
When owner-managers think about salary and dividend planning, they often focus on reducing taxes today. But there is another important question that should be asked before any compensation strategy is designed. Will you need a mortgage or other financing in the future? This conversation is frequently overlooked, yet it can have a major impact on compensation planning decisions. At the center of the slide, we see a business owner standing at a crossroads. One path leads toward lower taxes today. The other leads toward stronger mortgage qualification in the future. Many owner-managers want both, but in some situations there can be a trade-off. On the left side of the slide, we see a tax-focused strategy. By taking more dividends and reporting lower personal income, the owner may reduce their current tax burden. This can look very attractive from a tax perspective because less personal income is reported and less tax may be payable today. However, lower reported income can sometimes make future borrowing more difficult. On the right side of the slide, we see a mortgage-focused strategy. Here, the owner maintains documented income through salary, T4 slips, pay stubs, and notices of assessment. These documents provide lenders with evidence of stable and predictable personal income. This often makes mortgage applications easier to support and can improve borrowing capacity when purchasing a home, refinancing property, or applying for major financing. The process shown at the bottom of the slide highlights the correct planning sequence. First, understand the client's future mortgage or financing plans. Next, determine the level of personal income that may be required. Then design the compensation strategy that supports those objectives. Only after those discussions should the final salary, dividend, or hybrid compensation mix be selected. The key lesson is simple. Compensation planning should never happen in isolation. A strategy that saves a little tax today may create challenges tomorrow if the client later discovers they cannot qualify for the financing they need. That is why experienced advisors always ask about future borrowing plans before making compensation recommendations. Tax efficiency is important, but a successful compensation strategy must also support the client's broader financial goals, including future home ownership and access to credit. To understand why mortgage planning matters in compensation decisions, we need to understand how lenders evaluate income. Many owner-managers assume that if their corporation is successful, obtaining financing should be easy. However, banks and mortgage lenders often look at the situation very differently. At the center of this slide, we see a loan officer reviewing a mortgage application. The key point is that lenders generally focus on demonstrated personal income, not just corporate success. On the left side of the slide, we see the types of information banks like to see. A T4 slip shows documented employment income. Consistent salary demonstrates stability and predictability. Notices of assessment provide evidence that income has been reported and taxed. A stable earnings history over several years helps lenders assess repayment capacity. Together, these items create a clear and verifiable picture of the applicant's financial situation. When lenders see consistent and well-documented personal income, the approval process is often smoother and borrowing capacity may be stronger. Now look at the right side of the slide. These are the situations that often create questions for lenders. A shareholder loan account is generally not considered income. Very low personal income may make it difficult to demonstrate repayment ability. Large corporate profits do not automatically translate into personal borrowing power. Irregular withdrawals and inconsistent income patterns can make it harder for lenders to evaluate the application. From a lender's perspective, uncertainty increases risk. and increased risk often leads to more scrutiny, reduced borrowing limits, or additional documentation requirements. The example at the bottom of the slide illustrates this concept perfectly. A corporation may generate $300,000 of profit, but if the owner reports only $40,000 of personal income, the lender may focus primarily on the $40,000. This can surprise many business owners. They see a successful corporation, while the lender sees limited personal income available to support mortgage payments. The key lesson is simple. The corporation may be highly profitable, but lenders often care more about personal income than corporate income. That is why compensation planning should always include a discussion about future borrowing needs. If a client expects to purchase a home, refinance a property, or apply for significant financing, maintaining sufficient documented personal income may be just as important as minimizing taxes. A successful compensation strategy should not only reduce taxes, it should also help the client achieve their broader financial goals, including access to financing when they need it. This final mortgage planning lesson brings everything together. As tax professionals, it is easy to focus on minimizing taxes. After all, reducing taxes can create immediate savings for the client. However, compensation planning should never be evaluated on tax savings alone. Sometimes paying a little more tax today can create a much larger financial benefit tomorrow. On the left side of the slide, we see an aggressive tax minimization strategy. The owner primarily takes dividends and reports lower personal income. This often results in lower taxes and more cash retained in the short term. From a tax perspective, this may appear attractive. However, lower reported personal income can have consequences when financing is needed. Mortgage lenders may view the applicant as having lower borrowing capacity. Additional questions may arise. More documentation may be required, and the approval process can become more difficult. In some cases, the client may qualify for a smaller mortgage than expected or face challenges obtaining financing altogether. Now look at the right side of the slide. This owner follows a mortgage planning strategy. They receive salary and maintain documented personal income through T4 slips, payroll records, and tax filings. As a result, lenders can clearly verify income and assess repayment ability. This often leads to stronger borrowing capacity, easier qualification, and greater flexibility when applying for mortgages or other forms of credit. Notice the scale in the center of the slide. On one side, we have tax savings. On the other side, we have mortgage approval and borrowing power. The goal is not to maximize one side while ignoring the other. The goal is to find the right balance based on the client's objectives. For a client who plans to buy a home, refinance a property, purchase a rental property, seek major financing, or apply for significant credit in the near future, documented income may be extremely valuable. This is why experienced advisors ask these questions early in the planning process. Are you buying a home? Will you refinance a property? Do you plan to purchase rental real estate? Will you require major financing in the next few years? The answers to these questions can significantly influence the ideal compensation strategy. The key takeaway is simple. A compensation strategy should support both tax efficiency and future borrowing goals. The best plan is not necessarily the one that produces the lowest tax bill today. The best plan is the one that helps the client achieve their overall financial objectives, both now and in the future.